Welcome to the Clear to Close podcast with your host, local mortgage expert Ryan Bolton. Ryan has the questions and answers, tips and tricks, do's and don'ts, and expert guests to explain all the steps needed to buy or sell real estate. And now it's time for the Clear to Close podcast.
Hey everyone, my name is Ryan Bolton and I am a mortgage nerd. Check me out on Facebook at MortgageN3rd. You can also check out the YouTube channel here, like and subscribe. If you have any topics or questions or would like to be a guest, love to talk to you about adding content to the show. But had a lot of fun doing this. It's been really fun getting to know how the whole process works of posting and sharing media and just kind of keeping myself on my toes a little bit with coming up with topics and talking about an industry I really love. I love helping real estate or people buy real estate, refinance, sell. I love doing fix and flips. I do private money lending. I often tell my clients that I sell money for a living. So if you need some sort of money source when it comes to buying real estate, I'd love to be that source for you. You can check out my website at ryanbolton.com. But today I thought I'd have a little bit of fun. And I've got my producer here, Freddie Mac. He's a fun guy to have around, and he's helping me produce the show.
I'm hilarious.
He is hilarious. And so I thought it'd be fun again to do just a Q&A because I think finding questions that people are asking about, what are the trending questions, and just kind of keep me on my toes and see if he can stump me, which last time, not even close. So let's see what he comes up with today. So we're just going to do some random questions off the internet and some were actually submitted to our website, so we'll answer some of those as well. But let's just jump into some questions. So what do you got for us today?
Would I get questioned if I keep paying my mortgage with cash, for my meth business?
Does it really say meth business?
Actually, no, it doesn't. I threw that one in. I was watching Breaking Bad yesterday. Anyway.
Oh, great show. Great show. That's probably the last show that I actually really watched, really watched the show. But how do you pay with cash?
You just walk in. Well,
I guess if it's the local bank or credit union, you're going in and making the payment.
Yeah, but what local bank or credit union keeps your loan?
Right. So that's a really weird question because unless they're able to go down to a branch and pay with cash, I would also say it depends on the amount. So the IRS anti-money laundering laws kick in after a certain amount of deposit, like a total dollar amount. But if you're $1,500, $2,000, $25,000, but if you bring in $10,000 worth of cash, they're going to say, hey, where'd this come from? And a lot of it has to do with anti-money laundering laws. That's really where that stems from, this kind of anti-cash that everybody feels like banks and the federal government's kind of anti-money, anti-cash to try to go to a full digital system. And there's all kinds of nuance with that. I'm not going to get into all the conspiracy theories about getting rid of cash altogether. But I would say, no, they're not going to get suspicious if you're bringing the cash in every month, which is pretty rare. You can bring it into one credit union or bank as long as the amount's not over a certain amount. I think it used to be $4,500. Most lenders are starting to even go down and be under that threshold a little bit just because there is so much money that's floating around there from illegal or other types of activities. So short answer is probably no, but long answer is why are you paying with cash all the time and not just getting it into an account? But if that's how you're getting paid with tips or other forms of income, eventually gets into the checking account, and then you write the check to the mortgage company anyway. But I think it's pretty rare that mortgage companies really take cash because most of them aren't a branch or a bank right down on the street or the corner where you live that you're making your mortgage payment on. So yeah, what a great first question. My goodness. What else you got for us?
What can I do if my wife co-signed on a mortgage for somebody else without my knowledge 10 years ago, and now the mortgage is in question?
Ooh.
That's very specific.
That is very specific, and there's really not much you can do as a non-cosigner. So if your spouse did that loan 10 years ago and they co-signed on it, they're equally responsible for it. So I recently had a client that wanted to co-sign, and they thought that, I'm only having to co-sign on 10% of the payment because they're only 10% short of qualifying. So they thought, okay, I'm just helping them fill that gap. No, when you co-sign, you're as equally responsible for that loan as anybody else that signed on that loan. You're on title, it's on your credit, the taxes and insurance are in your name. Everything is if you both got it because you would not have gotten that loan without you both being qualified. So you're both fully qualified. It's not like you're only 20% responsible. So if you co-sign for a family member, a friend, and they miss the payment, it affects your credit. It's going to show up as a 30-day late, or it's going to even go into foreclosure. So if your spouse co-signed on a loan 10 years ago and that loan starts to go bad, it can affect her as well. Whether it's a foreclosure, going late, any kind of loan. It doesn't have to be a mortgage or it could be a car loan. Anything you're co-signing on, you're equally responsible because the bank is saying no to the first person. The only reason they're saying yes is because you're being added to the loan. Not 10% of you, not 20%, not just your credit, not just your income, your entire file is what's strengthening that loan enough to where the bank now says, yes, this is low enough risk because he's on the loan, she's on the loan, and this guy's on the loan too. Now I got 3 borrowers that are all equally credit available. Now I will tell you this as well, just because you get a cosigner doesn't mean you automatically get the loan. It's the same thing. If that cosigner has a lower credit score, or they're maxed out on their credit cards, or they're maxed out on their debt ratio, they're not really adding or strengthening the overall file. So the shortest answer I can answer for you, if she signed the dotted line, she's equally responsible for that loan. If it goes into foreclosure, it goes on her credit.
Actually, I have an offshoot of that question there.
Okay.
You almost touched on it there. So a number of years ago, my wife and I applied, and since we were both applying, we got denied. When it was only me, I got the loan.
Interesting. So in that scenario, I usually see it the other way around, where the husband has all the debts in his name. The wife makes enough income where she can qualify on her own, but adding the husband adds a bunch more debt to the file, and all of a sudden you're not approved. So it's not so much how many borrowers are signing on the loan, which lowers that risk. It's how they each stand kind of on their own. And if one can't do it on their own, you have to co-sign. But I have seen times where, usually the other way around, where the husband has the car loan in his name, the debt's in his name, the visa, a mortgage, a foreclosure, all this more stuff, and the wife doesn't and has income, she can qualify on her own. She doesn't need the husband on the loan. But you do want to make sure you're at least on the property. So if you do have a situation where you're husband and wife and only one needs to be on the loan to qualify for credit or whatever the reason is, you do want to add yourself as an owner of the property. To do that, in Utah, you sign what's called a warranty deed that adds you or a spouse. This is how you move a property into a trust or a living will or an LLC, is you sign a document that moves the ownership into that entity or adds that person to the loan. Not to the loan, to the property. But also, just because you're on the property doesn't mean you're on the loan. The loan is the collateral. So there is things you want to do there for sure.
Alrighty, next question here. What do we got here? What questions are mortgage lenders not allowed to ask?
We're not supposed to ask if they receive child support, separate maintenance, or alimony. Now, if they want to disclose that and they want to use that to qualify, there's guidelines to use it to qualify, but we can't ask if you're receiving those things. So that's one of the questions. It's probably a little nuance to it because people will want to offer that, but it's not something that we have to.
You can't ask if you're receiving it, but you can ask if you're paying for it?
Yes.
Okay.
And the reason why, because it becomes a debt, the other one becomes an income stream. You don't have to say that's an income stream coming in. And once you say, yes, I do get this $1,000 a month in alimony and child support, there's guidelines on whether we can use it. Most of it is making sure it's consistent. Unfortunately, there's a lot of people that have child support, separate maintenance, and alimony that's court ordered, but they don't pay it, or they don't pay the full amount. And then it goes into ORS or goes into some sort of service where they force it out of a paycheck. And so it gets kind of ugly on if it gets late or doesn't get paid. But we're not supposed to be able to ask if you're receiving it. We do have to find out if you're paying it as part of a debt. So that's the first one that pops in my head. We do have to ask about their age, but it's not based on what kind of loan they get, just to make sure they're old enough to get a loan. We do ask for dependents and those types of things. But that's probably the first one I can think of, is if you're receiving child support and separate maintenance, unless you're wanting to use that or need to use that to qualify for a loan, we can't specifically say, hey, by the way, are you getting child support, separate maintenance, and alimony? I see you had a divorce. So technically, we're not supposed to actually ask that. That's one of the first things that pops in my head.
All right, what questions do I need to ask my mortgage lender before I decide on a fixed or variable rate?
The big question I'd say is how long you're going to keep the home. Variable rates were pretty popular. There's still certain programs that are more like bridge loans or maybe for self-employed that they don't have enough tax return, so they just need kind of a little bridge loan to get them a few years down the road. But we're not seeing a huge difference in interest rates because the secondary market doesn't really like adjustable rate mortgages either. So they've kind of been phased out over the last few years just because it's not much more to just do a 30-year fixed. There are some benefits with it, with having a little bit of a lower introductory rate. But that's really the question I would have when I'm sitting down with a client. If the client's buying a house because they're going to live here for 1 or 2 years while their kids go to school and then they're going to move, or they're going to relocate, or they're going to sell another property, pay this one off. So really, how long are they going to be in that home should determine what type of loan that you get. And ARMs are really good if it's more of a short term, whether you're going to be able to pay the loan off with an inheritance or selling another property or retiring, and you'll get money to where you can just get rid of that loan. You don't need it for 30 years or even 10 years. You only need it for 3 to 5. If you know that window is there, or pretty certain that window's there, that's where an adjustable rate mortgage makes a lot of sense. But if it's just to get a lower introductory payment and you have to deal with refinancing or selling it without wanting to, in a sense, that's where the 30-year fix makes a lot more sense. But it's crazy. Over the last few years, as I've priced them out, and I've had clients sitting there and say, well, here's your 30-year, here's your ARM, and it's like barely lower. Most people just stick with the 30-year fixed, and because the market doesn't really like them. The secondary market isn't really buying those up like they used to, because they were lower rates and they had to refinance. They had prepayment penalties. They had a lot more kind of incentives to get those loans turning. There really is just not a market for it. So the shortest answer I would say is, how long do you plan on keeping the home? That should dictate whether you do a fixed or an adjustable rate mortgage.
Next question. Should I take out a subprime mortgage?
Boy, that's an old question. So subprime is anything that's not Fannie and Freddie. That's really the basic answer for that. It's now changed to non-QM or qualified mortgage. They kind of changed the name. I mean, that's what you'll see is if something's broke, there's a lot of things that still we're working with. We'll just rename it and reship it out there. We'll change the name of it and we'll send it back out, and it's a brand new product, even though it's really the same stuff. So subprime was anything that wasn't a prime loan. So technically, FHA is a subprime loan. Technically, it doesn't fit those guidelines of Fannie and Freddie. It takes lower credit scores. It does higher loan to values. It does higher debt ratios. So it's a little higher risk of a loan than the traditional Fannie Freddie conventional prime mortgages. But the question really comes down to, what are your needs and which one best fits the needs? Many times you can't qualify for a prime loan. That's why the subprime loan market exists, because there's still a need. There's still guidelines that people can't quite fit, but they got the money, they got the credit score, they got some reason to get a home ownership, but maybe there's one thing they can't qualify on. So these programs are designed to kind of catch that next step down from A-paper loans. If only everybody could get the A-paper loans, there'd be a lot of people that couldn't be in a home. And I think it's still better to try to get you into a home than just not being able to fit in that particular box. So that's where the market, where investors will say, okay, where are the reasons we're saying no? Well, we're saying no because the credit score is not 900. Well, what if it was 750? What if it was 650, but they've been on their job for a long time? What if it's a 650 score and their debt ratio is lower? What if they're in the process of getting their scores up? Maybe it's medical. Maybe there's other reasons why the scores are lower, that this box just says no, hard and fast, nope, you can't get a loan. But this guy's like, yeah, I'll take on that risk. Maybe I got to bump the rate a little bit, but I'll offer that client a loan to give him a chance to get into a home while offsetting the risk with interest rate or other compensating factors. So just to say, hey, I'm never going to get a subprime loan, that loan fits a need in the marketplace because the other loans can't do it. That's why that loan exists. So I think it's still worth looking at the options, finding out why you can't get the prime loan, but that's the next best loan to get. It still makes sense to move forward. Don't just because it's called a subprime loan, just, oh, no, I'm never going to do it. It's a scary. It's like, no, why is it that way versus why it's not? That will help you answer that question. So, yeah.
All right, next question. I'm buying my first home next year, and I have a few questions. What is necessary for a low mortgage?
What is necessary for a low mortgage? Well, the best interest rates are going to be with higher credit scores, lower debt ratio, more time on the job, and lower loan to value. Mortgage rates are based on risk. They're just like insurances in a lot of ways, that the lower you can make the risk, the lower your interest rate is. So some things you can't control, like how long you've been on the job. That's going to take time. But having more down payment will lower the risk. Having a higher credit score, having a lower debt ratio. Debt ratio is a really big thing. If you've got all your debts under control, you have very little debt, maybe a car loan, a Visa, and that's it, and you have that money left over, that's a big compensating factor to lenders. So to strengthen your file over the next year is really manage your credit, manage your other debts, stay on your job, get all the hours you can. I've had a lot of times where people are scheduled to work 40 hours at a certain dollar amount, and they always are under that amount. So when we kind of go to figure out the average of their income, it's not quite what they said it was. So these are things to help. If you got a year to work on it, really start with credit, because credit takes the most time to rebuild or to work on. So I think it's real important to kind of see where your credit's at, what you can build up over the next year, but just keep your expenses lower and have more money in the bank. Those things will offset risk, lower interest rate. All right, what else you got?
Still looking for a good one. Hold on a second. Pontificate for a second.
Pontificate. Ooh, I don't even know how to spell that word. I'm not the best speller. So I really appreciate the show. I think this has been a lot of fun. If you'd like to be a guest, if you have questions, if you have topics or something you want me to answer, I'd love to you can put that in the comments below. Please like, subscribe, send this video out if you have anything if you're looking to buy a home this year, next year. I do lending in Utah and Nevada, so you can check out my website at ryanbolton.com. But I'd love a chance to work with you on any kind of financing needs you might have. But it looks like we got another question. So what else you got for me?
How much mortgage can I get if I have bad credit, but I have a good job and diamonds and rare coins and other valuables for collateral?
Ooh. Are these collector coins? Or are we talking like Bitcoins?
I think they're old Chuck E. Cheese coins and a binder full of garbage pail kids.
Oh, man, that is funny. This is probably on Quora, and some of the questions I see a lot is this idea, how do I get a loan with bad credit? I always say, why is the credit bad? What can we do with the credit that helps you get a better loan? Because credit ties to everything. It ties to car loans, insurance, employment. There's so many things tied to credit that if you got coins, Pokemon cards, something to be able to sell those or get rid of those to get the credit better, you're better off doing that than having a bunch of coins sitting there. So it is something where a lot of times I sit down with clients and explain how credit works. I'm amazed at how often adults, let alone kids, just don't know how credit works. Maybe they got stupid loans, they got student loans, they got visas, they got all this stuff when they were early on, when they didn't know how applications worked. And now they're kind of regretting it. They didn't make the payment. They got a cell phone that was $1,000 and added their payment. They stopped making the payment. Or they got some internet service and didn't turn in the modem, and they got some collection account. I mean, it's amazing to see how bad some of this credit can be. It could be fixed with $1,000, $2,000 or something, just going through and settling and just getting it cleaned up. So I really tell people, yes, you can get a loan with bad credit. Is it going to be a good loan? Maybe not. Probably not. Not as good as if the score was better. So let's work on getting the score better. Let's take a couple of months. Let's take 90 days. Let's take 6 months, depending on what we're working with, and let's get your score up. It's not impossible. If you know how it works, you know how to make it better. And there's so many times where I can sit with a client and say, okay, if you go do X, Y, and Z, you'll see a bump to your score. And so many of them will either just not take that advice and go off and do whatever they're doing. But I'm amazed at how many of them will come back in 60 days and say, Ryan, my score went up 40 points. Yeah. Now you get a better loan. So I really think it's important to start that pre-approval process. Call me. I can help you in any state. It doesn't have to be just Utah and Nevada where I do my lending. I'd love to help you with credit because I think the credit really can be your first step to better everything when it comes to financing. Car loans, insurance, employment. If you have bad credit, do you think you're also going to get the best job or the best promotions or things like that? Because if they see you're not managing that part of your personal life and you got all this debt and you got collections, they don't want to have to deal with some collection company saying, hey, we just garnished this guy's wages. Now you got to send us a check instead of sending it to him. You know what I mean? So the credit can be just a report card on how you're handling your finances and working on that, knowing how it works, and just getting your head out of the sand and go deal with those collections, go deal with the things that hurt your credit years ago. You'll be better for it. So start there. But I can't tell you how many times we can help you with your credit with just 60 days. Give me 60 days. I guarantee you I can get your credit score up with just a few little tricks and just a few little ways of getting it cleaned up. So work on your credit first, and I can help you with that. So check out my website, ryanbolton.com. It's got my phone number there. I can talk to you. We can pull credit, do a soft credit pull, kind of go through where you're at and what it's going to help you to get to the next level. So work on your credit. All right, what else you got?
Okay, I'm going to change this one around just a little bit. What's the strangest question that you've been asked when somebody has been applying for a mortgage?
Oh, man. Strange is kind of an interesting question because I've had people think that they're like auto loans or what I can use for collateral or bad credit, that type of thing. So let me think here for a second. What is the most common? I would say that's really is getting a loan with bad credit's probably but we just talked about that. So that's probably why it's fresh on my head. I've had people say, can I get a loan on a home I don't own? I've had that pop up. That's probably the one I think this the weirdest is somebody saying, hey, I want to get a loan for a mortgage, but I don't own the house or something like that. I don't know. I can't think of anything. That's a good one. He might have stumped me with one that isn't like a trivia question. It's like a experience question. I don't know, man. Good one.
Yeah,
is that a stump? Put it in the comments below. Do you think he just stumped me with a question? What's the most weird question I've got?
Or are you holding question back or holding responses back because they're just too specific and somebody would know it's about them?
Yeah,
I asked them that question.
Yeah, I'm like, oh, Greg. I had this one guy, Greg. Oh, man. I had one where can I do a loan without the person signing for it? I remember that was kind of a weird one. There was like a spouse situation going through a divorce. I thought that was kind of interesting. Well, can I use my husband's credit, but he doesn't have to sign the loan? Can you not send him the appraisal and send him all this stuff? And I was like, something weird's going on there. I remember that one was kind of an awkward one. I did have some guy that falsified documents. That was we needed like an extra deposit. We had like this deposit that showed up on his credit, and he said he sold a car, and then when I tried to get proof of that check, he sent a check that was completely altered to match that amount. And it wasn't even a good forgery. You know what I mean? It might have slipped through if it was done right, honestly. I mean, because it looked like a bank check, everything, but you just kind of looked at it and you're like, the fonts are different. The size is different. It's not square. It wasn't even close. It was like, oh, man, what's this guy doing? So I'd say that's probably the stuff that occupancy, I would say that's probably the number one fraud in our industry is people claiming it's a primary residence when it really isn't. So they'll ask some questions like, well, how long do I have to live in the home before I rent it or, rent it VRBO or something like that. So that's where you get that's probably the most number one fraud in our industry is some sort of occupancy fraud. Is they're basically saying, yeah, this is a primary residence when they intend to rent it or use it as a VRBO or something like that. So, yeah. Okay.
Alrighty, our next one here. Which is a better method while obtaining a 30-year fixed rate? Buying point or paying more on the down? I recognize this comes as a first-world problem. Okay.
Yeah, I mean, everybody's got debt, and this is a debt question. So that generally is so when you buy down interest rates, it's not like it's always a point for point or quarter for quarter. So it does fluctuate, and it increases over that time you go down the list. So maybe let's say you're 7.5%, and it's a 1 point, just for instance, 7.5%, 1 point. To go to 7.25%, it's not a quarter fee increase. It could be another full point to buy it down that 0.25%. So, but then maybe the next tier doesn't jump that much. So you really have to kind of price out top and bottom, fee to rate combination to see what is the payment difference versus the extra money cost. But generally speaking, I would say more money towards the down or lowering the loan amount will go further than buying the points because it usually would reduce that more. And it's something where if you only have the loan for a certain amount of time, you're not gaining that buy down. So if you say you buy down the rate 2 points, but you only keep the loan 2 years, you paid more upfront than the benefit of how long you were keeping the loan. So here's the math to do. When you're talking to a loan officer, say, okay, what's the rate we're getting offered? What's the next tier down? What's the payment and cost differences? If you divide those out, it'll tell you how long you have to keep the loan to break even. I know it's hard to do math over a video or over a call, so give me a call if you want to get real specific with that, if you're running into that situation. But generally, putting it towards the principal is going to be better. But honestly, the best place to put it is any other debts. So if you have a Visa, a car loan, anything there, it will go further. Like if you put 10 grand down on a mortgage, you might save $75. But if you put 10 grand down on a car loan that you have, or maybe get rid of that car, you could be getting rid of $200, $300, $400 a month on the car loan. So I would say generally, if you have kind of a certain number of money to work with, other debts first, then probably principal, and then look at those rate to fee combinations to see if there is just a small increase in fee to jump to another tier in rate. But you usually see kind of a big jump, then a small one, then a really big one. You'll see kind of these tiers of these interest rates, and sometimes it's not that much more to go an eighth better on the rate or a quarter better, and other times it's like a whole point more to go an eighth better, and then it's only a quarter after that. So you'll see that they'll kind of have these weird jumps all over depending on that day's interest rate. So, but it's important to kind of know where that question is, because if you don't have the math, it's hard to know what is the best option. So looks like we got about 1:40. Maybe we squeeze one more in.
My household gross income is about $250K, but I filed for Chapter 7 bankruptcy in 2017. This is a couple years old. Question, should we apply for a mortgage together, or should my husband apply for it himself?
It depends on how the credit scores have rebounded from the bankruptcy. Most loans, the better loans, require 4 years from the discharge date. So once you're discharged from the bankruptcy, after 4 years, you open back up. The bankruptcy really doesn't affect you other than how it's still affecting your credit score. What I see with bankruptcies a lot, and this is where I can help with credit repair, is they just bury their head in the sand. They forget about stuff. Stuff just lingers. It just stays there even after the bankruptcy, because whatever reported at the bankruptcy, it just stays there. So it could be a zero balance now, but the credit still shows you owe 10 grand to some creditor because they just stopped reporting. So updating the credit file, make sure it does reflect that everything's paid, everything's settled, it's closed out, it's part of that bankruptcy will be the first step. But once you reach 4 years and your credit score has recovered, you won't be a worse candidate than just your wife by herself. Plus, if your wife doesn't have the income, you've got the income, she may not be able to qualify on her own. You may need your income. So if you have gone through a bankruptcy, foreclosure, something like that, especially if it's a few years ago, you want to start working on making sure everything on the credit's updated to at least 0 and included in the bankruptcy, and then you can start working on buying a house. But you really got to wait basically 4 years. There's programs where it can be less, but if you get to the 4-year mark, it's as if the bankruptcy didn't happen as far as a time frame, but it may still be affecting your credit. So I hope you enjoyed the show. If you have any questions, comments, please post them below. Check out my website at ryanbolton.com. And this is Ryan Bolton. I am a mortgage nerd. Love a chance to work with you on your home loan.
This has been the Clear to Close podcast. Please submit your comments, questions, and topics for future episodes to cleartoclosepod@gmail.com. That's clear the number 2, closepod@gmail.com or ryanbolton.com. Please like, follow, and share. And until next time, this is the Clear to Close podcast. The views expressed in this podcast do not necessarily reflect those of Patriot Home Mortgage, Equal Housing Lender, NMLS number 299717. This has been a production from a podcast studio.